All right. Hey, we want to welcome everyone for our meeting today. And at this point, I'll turn things over to Brad Smith, who's going to be moderating the session today. Thanks, Brad.
All right. Thanks, Matt. And again, as Matt said, we're excited about today's panel. We've done this over the last year and a half of really bringing together a diverse panel to share insights that are impacting the market that ACG is really about in creating this ecosystem around private equity. So today we welcome three of those individuals: Dave Alston from the Harbor Group, Chris Kramer from BKD, and Jonathan Miller from Frost Brown Todd. And what we're going to do is, to kick it off, I'm going to go through kind of in reverse order of what you just see and my introductions there, and ask them to give a brief intro on themselves. And then they're just going to give some opening remarks from their perspective of the landscape of what might be impacting this ecosystem. And then we'll get into some moderated questions, and hopefully, more importantly, that you as an audience will have some questions and drop those in chat as we round out this session. So without further ado, I'm going to ask Jonathan to kick us off with some brief intro and overview remarks from his seat in the ecosystem. Jonathan, welcome.
Thanks, Brad, and mazel tov to Matt, and welcome to everyone at this morning. I'm Jonathan, and I'm a recovering politician. I was state treasurer for 2 terms here in Kentucky, and ran for governor. People of Kentucky overwhelmingly decided they wanted me to be in the private sector, and I have been with Frost Brown Todd for be a decade in a couple weeks. I am primarily my subject matter expertise is in hemp. I'm a hemp lawyer and general counsel to the U.S. Hemp Roundtable, which is the hemp industry's trade association. But I also am supposed to be in Washington, D.C. In Frost Brown Todd's new office, helping lead that effort there. Supposed to, this COVID thing got in the way, and I've become your typical Washington lobbyist operating in his sweatpants in his home office in Lexington, Kentucky. But my job is virtually in D.C., and so I'm following very closely the goings on up there. And one of the reasons why Frost Brown Todd is opening a full-time office in D.C. is because there is a real opportunity for change for our clients and for folks like yourselves. This move to a Biden administration and a fully Democratic Congress means that there are going to be so many issues for folks not only in your field, but who touch upon subject matters and issues that have a federal nexus, which are a whole lot of issues. I do want to start off with a kind of cautionary note to understand that just because we've gone from a Republican president, Republican Senate to an all Democratic three branches or 3 segments, that does not mean that we will see overwhelming change. Even though the Democrats control the presidency, the House, and the Senate, things are too close for us to see a dramatic left turn, per se, in government. So much of that has to do with the way the Senate works and the fact that the Senate is only 50-50 with the vice president breaking a tie. But yet on so many matters, it requires 60 votes. The Democrats have been talking about getting rid of the filibuster, but swing votes like Joe Manchin and Kristen Sinema have made very clear that they are not going to support that effort. So on most matters, you're going to need to get 60 votes to get through the Senate, which will block a whole lot of things that might be scary to you if you are consider yourself right of center politically, or if you are investing in things that might be less popular on the left side of the aisle. On occasion, you will see the Democrats use a process called reconciliation, and you've probably been hearing a little bit about it if you've been following the news closely, where all they need is the 50 plus the tie-breaking vote to get through matters that have a budgetary impact. And they are using this currently on the COVID relief bill. There's a big debate as to whether or not a $15 dollar per hour minimum wage increase will be made part of that. Again, reading the tea leaves, my bet is that doesn't happen because that does not have a complete support. It would need unanimous support in the Democratic caucus to be on the Senate side to be part of that. But you will see occasionally Democrats using reconciliation to do things. They most famously used or infamously used it, however your politics are, to get Obamacare passed. Republicans used it under Trump to get the tax cuts passed. And so when you see on budgetary matters, you'll be seeing this kind of usage, rare, but on important occasions. So what does this mean from an issue standpoint? You'll be hearing much more from Chris later about taxes. I don't want to go into that because you've got a real expert talking about tax policy. But I think if you're investing on the environmental side of things, this is going to be a real area to watch. There's not the need to pass legislation to really ramp up the regulatory footprint of environmental agencies in Washington. And so we really do expect to see more challenges, more difficulties for fossil fuel industries, while more opportunities for clean energy. Right now, you're seeing this debate go on in Texas with some folks arguing that the lights out power outages down there are blaming it on wind turbines, and others saying that if you're going to blame it on clean energy, Texas is the wrong state to be blaming it on. But you'll be seeing that continue to battle out, and I don't expect any groundbreaking legislation again because of the 60 vote margin needed and the hostility of any major legislation from the Republican side. But there's a whole lot that can be done both by executive order from the president and certainly on the agency level. So I would be very cautious about that. Going to the subject I know best, hemp and marijuana, I think you're going to be seeing a real sea change in terms of how the federal government treats that. We could very well have decriminalization, if not legalization, of marijuana in the next couple of years, and as a result, you've been seeing marijuana stocks go up since the election and the Senate switch. And so Senator Schumer has made marijuana a big priority of his. And he's trying to fight off a possible primary challenge from AOC, and is using this issue to do that. And so there's a decent chance you might see some movement in the Congress, because it's not an overwhelmingly bipartisan issue, but there are a lot of Republicans, Rand Paul being one of them, who do support marijuana legalization and decriminalization. You're obviously going to be seeing a lot of movement on healthcare. There will be efforts to try to expand Obamacare to provide for a public option. Again, that's going to run into the 60 vote difficulty, but the Democrats were able to finagle that last time when they had a nearly small margin in the Senate, and we could see some activity on that side. You're going to see also, I think, more regulation of social media. There is bipartisan consensus on that. Now, of course, there's bipartisan disagreement about what the problem is with not just social media, but big tech, the Googles, et cetera, of the world. But I would expect a Biden administration to be more focused on that. And finally, I'll mention, we expect in the coming days there to be an announcement that Congress will go back to the practice of earmarking. That is where individual Congress men and women are able to put something in a bill, an appropriations bill, that targets a particular sector or a particular project in their district. This was gotten rid of as a way to kind of reform the government spending, but Democrats have generally been more in favor, and frankly, it gives leadership more power to pass bills because they're able to horse trade away earmarks to get bigger legislation passed. So I'll stop there, and I know you're going to have a lot of questions here, but really just understand that I do not see a revolutionary sea change at the legislative level. Where you will see most of the change is regulations. You're going to see more of a regulatory state in the areas I mentioned and other things that I didn't mention. Thanks.
Jonathan, thanks for kicking us off, and thanks for investing time with us. And we're going to pivot now to Chris and bring us some insights that Jonathan kind of teed up a little bit from a tax front. So Chris, welcome, and the floor is yours.
Thanks, Brad. Jonathan, I feel a lot better. That was positive. We're not gonna, we're not gonna see sweeping tax reform again. When you're a tax accountant, that makes you feel good. A little bit about me. I'm Chris Kramer. I'm a tax partner at the accounting firm of BKD. My office is here in Louisville. I grew up in the Washington, D.C., Northern Virginia area. When I was 23 years old, I met a beautiful blonde flight attendant from Kentucky. And my life is kind of a blur. Now I got 4 kids, 2 cats, a dog, and I live in Kentucky. So that's how that goes. I spent the first half of my career with one of the large multinational firms, and the second half of my career here at BKD. My practice is largely, I'm a member of the firm's tax merger and acquisition group. So I spend a lot of time working on tax transactions and structuring, which means we spend a lot of time working with private equity owned private equity groups and structuring transactions. I do also have sort of a traditional book here local in Louisville, but a large part of my practice is national. I put together a slide deck. If anyone wants it, then reach out to Terry McWilliams and he can send it to you. The deck sort of summarizes what Biden has proposed with regard to tax changes. It's about, I don't know, 25 or 30 slides, so it'd be brutal to go through it here. So I'm not going to subject everyone to that. But if you do want a copy of it, just reach out to Terry and he can make sure it gets emailed to you. What I can say is just at a high level, I think, there's philosophical differences between the previous Trump regime and the Biden regime when it comes to tax policy. Trump's idea was that, hey, we'll build a tax haven in the United States. We'll cut corporate tax rates below our competitors in Western Europe and Asia, where before, the United States was the highest corporate tax rate in the world. We're going to cut it all the way down so that we'll create a tax haven in the United States. We'll put tax incentives in place for U.S. companies to repatriate cash trapped overseas. We'll encourage foreign investment in the U.S. That'll drive the economy and expand payroll to expand the tax base, and that's the way to get the economy really ramping up and going. And I think the Biden philosophy, and you'll see it when you get my slide deck. If you look at my slide deck, you'll sort of see the philosophical differences. But the Biden philosophy is it's not the way to go about things isn't to give successful corporations and wealthy business owners tax cuts so that they'll expand their business. Rather, some of those successful people ought to pay at a higher rate, and that ought to provide some sort of a benefit for some of the people that are up and rising. This sort of Robin Hood mentality. So that you'll see in the policies of the two candidates that it's that different philosophy that sort of runs through all of the different changes that Trump put in place. And based on what we've heard from the president, at least in his campaign and what he's published, it just seems to me that what he'd like to do is just unwind most of the provisions that Trump put in place in 2017 with the Tax Cuts and Jobs Act and go back to the taxing regime that was similar we had under President Obama. Some of the things that Obama would talk about, $400,000. I'm not going to raise your taxes if you're over $400,000. You see that same $400,000 number popping up in some of the proposals from Biden. The tax rate structure for individuals that Biden's proposing for ordinary income is the tax rate structure that's similar to what the President Obama had in place. Corporate rates were 35%. They went all the way down to 21%. And what Biden's proposing is 28%, which would be a corporate rate that would be not as high as it was before, but that would be not a tax haven rate. It would be a rate that would be competitive with most of the European and Asian economic competitors around the globe. And then he's proposing, and any adjustment to the corporate rate, you need a similar adjustment to the businesses that are smaller businesses, flow throughs, S corporations and LLC partnerships. because you create a competitive disadvantage if you cut corporate rates for large multinational U.S. corporations, but don't provide similar tax adjustments for small business. So there's some level of small business. What Biden has said though is this magic $400,000 number. If you're a small business owner and you got more than $400,000 of income, maybe you should pay at a higher rate on your business income than the 28%. We'll see how that plays out. Probably the biggest thing that is out there would be capital gains tax. Biden has proposed an increase in the capital gains tax above what we had under the Obama regime. If you're over $1 million of taxable income, you're going to pay ordinary income tax rates on your capital gains. Under the Biden regime, that will be 39.6% federal tax rate plus maybe another 3.8% if it's a passive gain that you've incurred. And so you could be paying above 40% federal and then tacking on state rates. You could be paying close to 50% on capital gains. If you're over $1 million, the sort of trap there is if you're recognizing a significant capital gain, sort of a windfall event, the sale of a portfolio company, you may not be over $1 million, but then the windfall event's going to throw you over $1 million, which essentially is going to trigger potentially some of those ordinary tax rates on your gains. So that's probably the big thing. We'll see how that plays out. And then Biden's talked about reinstating some level of corporate alternative minimum tax that was repealed. And then there's 24 other things we could talk about. One other thing I'll mention that could be significant, and then I'll quit talking about taxes, Brad, is the Social Security donut hole. One of the things that he suggested is to raise funds for Social Security. The Social Security tax applies on earned income, and it's a 6.2% employer, 6.2% employee tax. It ends at an income level around $138,000. I think it's $138,700 this year. What Biden's proposing is that you wouldn't pay the 6.2% Social Security tax over that wage-based limit of about $138,000, but then it would kick back on at $400,000, and you'd pay the 6.2% again on wages and earned income above $400,000, which creates a sort of donut hole. And that 6.2% is a significant tax and could have a significant impact on earned income. And so probably the two most significant differences between the Obama regime and what Biden's suggesting is that Social Security donut hole and the increase in capital gains tax.
All right, thanks, Chris. It's a great overview. A lot of information there to process in a very short period of time, but I think you succinctly kind of summarized some of the key things that a lot of us are hearing sound bites on, on a nightly basis or a daily basis, depending on how we're getting our news these days. So our third and final panelist hails from St. Louis. David's become an active participant in our chapter here, which we've appreciated. A new face and new involvement from that. So David, welcome from St. Louis, and I'll kick it off to you to give us an overview of your background and some of your initial thoughts from your seat in this ecosystem.
Sounds good. Thanks, Brad. So as Brad mentioned, sit in St. Louis with Harbor Group. I'm actually on the road today. So I'm in the Grand Bohemian Hotel in Birmingham and found myself in the billiard room. So if it's a little bit echoey, I apologize. I'll give a little bit of background on myself and talk about Harbor Group a little bit, just to give some context, I think, for the rest of my comments for the day. But my background is very unique for private equity. I grew up in West Africa, in Togo, West Africa. My parents were missionaries, and I spent my 20s working in a church with the idea of training pastors for the rest of my life. And long story short, that didn't happen. I never got the chance to move back to Africa, and so I decided to go to school, got a JD MBA at WashU, and through that program got connected to Harbor Group. And so Harbor Group is a St. Louis-based operations-focused company. We do operate within a fund structure, but we don't refer to ourselves as private equity. Been around since 1976. Have acquired and built 214 businesses in 47 different industries over that time. mainly focused around manufacturing and distribution businesses, so highly engineered branded products, value-added distributors. Our family represents roughly 20 to 30% of each fund, and so there's very much a family office sort of a feel to what we do. And as I mentioned, on the operational side of things, we have 23 of our 30 people are ops, and they really act very much like a consulting group would with our portfolio company management team. So we take a very hands-on approach, have a little bit longer hold time than normal, so 6 to 8 year hold on average, and really try to buy and build businesses. And so what we have traditionally done is gone out and worked with investment bankers across the country, particularly in New York, Chicago, the big centers. And what we've started to do over the last few years is to take a different approach and to say, let's really focus on the areas where these businesses are, like a Louisville, like a Birmingham where I am now, and develop relationships across the board in those places to really try to connect with business owners ahead of time. What we're seeing now in the market is that you're seeing more and more deals that are being run on a very limited process. And you're also seeing people who have specialized in a specific industry or vertical. And so it becomes very hard for a generalist firm like us to be reactionary and learn as much as we need to learn. So we're trying to develop relationships to learn early. This past year is obviously very interesting for us. If you talk to a number of investment banks, they had a great year. So a lot of the investment banks I talked to sort of at the end of the year to get an end of the year review, they either had a record year or near record year in terms of deals that were done. And so a little bit unexpected when you consider Q2 of 20, just everything went dead. But if you look at tech, if you look at healthcare, very, very robust deal flow last year. Our area of industrials was much slower. We were about 40% off overall deal flow. So our average year, we'll see about 1,500 deals. Last year, we saw about 800, 900, somewhere in there. And so we are, apologize, did somebody come in here? So we are expecting 21 to be really busy. One of the things that we saw at the end of last year, especially with the smaller business owners, was real concern around what's going to happen with capital gains taxes. What is this going to do to me? And so one of the things you're trying to balance out, particularly in our industry, is how do you account for what happened in 20 and weigh that against the potential risks. So what we think is going to happen is we think that the second half of 21 is going to be really, really busy, particularly in industrials. But deal flow is really high across the board, not necessarily in our area yet, but we think the second half of the year is going to be really jam-packed. And then everybody that I've talked to on the investment banking side has said that pitch activity is very, very high, remains high. So we think there will be a number of people who are taking this opportunity to get out. I think it combines the capital gains, but then also concerns around COVID. I mean, if over half, maybe 70, 80% of your net worth is tied up in a business and you have COVID happen and you see it almost go to zero, that can be a big motivating factor to take time to get out. So we think those are sort of the big trends and themes that you're going to see. Happy to talk much more about individual, what we see in different markets later, but that's a good overview. Again, don't have a lot of specifics on taxes, but we think that we're going to see a very, very, very active 21.
Well, I appreciate the overview, David. And maybe I'm going to come back to you with the first question, just from the standpoint of, let's talk COVID for just a minute, and then we'll kind of maybe pivot away from COVID. Seems like we talk a lot about COVID, but all of us have had to alter the way we did business in 2020. That's continued in 2021. From things that have changed over, let's say, the last year because of COVID, what do you think sticks when we get to the other side? We see maybe a light at the end of the horizon with the vaccine. So fall, which you said is going to be extremely active in this space, specifically industrials. What are some of the lessons you think you've learned and changed from 2020 through today that will stick with you as the way you're going to do business in the new world, whatever that looks like?
That's a good question. So I would say the main thing is just to focus on relationships and how important those are. Just even whether it's with an investment bank for me or whether it's with a business owner, knowing trusted advisors, whether that's accountants, lawyers, wealth managers. I think those relationships are going to be much more important over time. And that personal touch, I think one of the things, I talked to a guy yesterday here in Birmingham who said that he lost 2 deals last year because he could not be in person. So finding a way to get around some of the restrictions, whether that's doing what I'm doing, and I play a lot of golf. I'm not very good at it, but I play a lot of golf just to get people outside and be with those people. I think that's the things you'll see. For us, it's a shift away from conferences. It's a shift towards a more focused approach. I think on the process side of things, when investment banks are running processes, they are running much more limited processes, and they're taking a group down a lot smaller before they'll get to in-person meetings. And so even though some of those have come back, it's basically how do maybe we'll start with an advanced group, go to 5 or 10 people and gauge interest, and then we'll open it up a little bit, but then we'll narrow it back down pretty quickly. And I think that will stick. I think you'll see a lot more virtual meetings to get deeper into a process. And I think that's going to happen more and more. And then I think you're going to continue to see more specialization, just where people have to pick their spots and they run hard. And I think you'll see that more and more. For us, again, it's a move away from a big conference. We like ACG, but going to a conference and having 70 meetings in 3 days is mind-numbing. And so building a relationship over time, we feel like, is going to be more and more valuable in the days to come.
Chris, Jonathan, anything to add on that topic before we kind of shift? All right, well, let's pivot then. There's 2 things, and Jonathan, you and Chris both touched on this. One is the stimulus package, or the next stimulus package. We've had several. And then the other is tax reform, tax change. So let's go with stimulus first. And Jonathan, let me come to you with the stimulus. What do you see as maybe the biggest barriers for getting this next stimulus across the finish line?
I think it's going to happen. I think there is a lot of will for it to happen. The battle right now is being fought within the Democratic Party. You have folks on the left who would like to see it be even larger than Biden suggested, and are really fighting to make sure that the $15 per hour minimum wage hike is going to be part of it. And that really is kind of a big rallying cry for a lot on the left side of the left. While you have Biden himself saying that he supports a minimum wage hike, but probably doesn't think that this is the right bill to do it in. And then folks, again, like the swing Democrats in the Senate, Manchin, Sinema, who don't think it should be part of this as well. So I think that's going to delay things. My bet in the end is that provision would be removed. But when you're dealing with, I think it's $1.7 trillion, figuring out how each of those dollars is spent is challenging in itself. So you're going to see a lot of horse trading in the days to follow. But I really do believe that there is a consensus, a unanimity among Democrats that they do need to do something. And probably from a political perspective, even more importantly, they want to give Joe Biden a win here. I think that those debates will find their way, and probably because this is where the center of power is, it's going to be more of a centrist bill than the left would like.
And just 2 follow-up questions on that. One, assume you believe it's going to happen. So what do you think the timing of that looks like, of when they get it across the finish line? And I think what I heard you say in your opening, you believe it gets to the finish line through reconciliation process, not through some bipartisanship. So maybe comment on those 2 things.
Yeah, when Biden started off, his inaugural speech was about unity. His campaign was talking about bipartisanship, and I think there was a real desire to do things in a bipartisan way. A group of 10 Republican senators met with the president, urging him for a smaller package that would get their support and would allow for 60 votes to be in the Senate. I think that there was a debate within the administration about it, but the lesson that they've learned, whether right or wrong, whether you agree or disagree, from the Obamacare, from the Obama stimulus back in 2009 was that they want to go big, and they'd rather go big than go bipartisan. They're worried that if they don't do enough, that we will not be able to climb out of the recession, and that they have gone with the preference of doing a Democrat-only bill, fearing that a bipartisan bill would not do enough to boost the economy as needed. And again, because of that, it will have to be by reconciliation. From what I understand, that through all the processes that have to happen, we're talking about probably mid-March before you see any final passage.
David, maybe coming back to you on that piece before we get into tax, do you see what's been talked about in the stimulus package and some of the ins and outs that Jonathan just hit on? Does it have any direct impact, do you believe, on the M&A market?
Well, it certainly did in the past. You know, we anticipated significant sort of distress situations last year and didn't see them. And so I think anytime you get the stimulus money that helps, particularly small business owners, stick around and continue to have a lifeline, that's good. The other thing that we saw that I thought was even more interesting than some of the businesses that didn't really have this huge crisis was a lot of business owners really didn't need the stimulus, and they were actually able to take that and do the next thing. So you saw a business owner who was sort of on the verge of having a really great outcome, and then they were able to move forward. So I think that's the other thing you're going to see is businesses that take the next step and really become, you know, beyond just small lifestyle business, but really grow into the area where they become very fascinating to us. So again, we just think it creates more opportunities for us, although not on the distress side, which is what we initially believed would happen.
Great. So let's pivot now, Chris, coming to you from a taxation standpoint. If you've got your crystal ball kind of shined up and kind of give the group a view, you talked about a lot of different potential aspects that Biden's put on the table and they continue to debate. So if you're betting today, what are probably the key aspects you see coming down the path that they can get across the finish line with tax reform?
Yeah, thanks, Brad. Yeah, you know, I'll make one quick comment on the stimulus bill. One of the things that's out there that I think we're going to get is an extension of something called the employer retention tax credit through the end of 2021. And the reason I think it's a good idea is because it has sort of a safeguard built in. What the employer retention credit is, a payroll tax credit that's very valuable if you qualify. It can be up to $7,000 in 2021. It'd be up to $7,000 per employee per quarter. So each employee that qualifies for the credit could be $14,000 payroll tax credit for the first quarter and second quarter of 2021. Employee retention credit was introduced with the CARES Act on March 27th of 2020. And it originally only applied to smaller businesses without getting into all the gory details. It generally had widespread application for employers under 100 employees, and the Taxpayer Certainty and Disaster Act relief, the December of 2020 round of tax relief that was passed, expanded that employer retention credit in 2021 to be eligible for widespread eligibility for employers of 500 or fewer. So we found that a lot more of our clients are going to qualify for this employee retention credit, $7,000 per employee per quarter in quarters 1 and 2 of 2021. But there is sort of a safeguard, and the safeguard was that your business, if your business has to be down 20% in 2021 compared to the same quarter in 2019, which was before COVID. So if businesses are down, they qualify for this credit. It's a leg up. You know, the government's helping subsidize the cost of payroll for businesses that are down. But if the economy recovers and your business is doing well, you kind of get kicked out of the credit. And that's sort of a rolling qualifier through the rest of 2021. So I would think that it would make sense, and that what we're going to see in the next round of COVID relief legislation that's passed would be an extension of that employee retention credit through the end of the year. You know, guessing on what's going to happen, you know, Jonathan kind of made the comment that seeing sweeping tax reform might be a tall order. What we might see more would be in the realm of executive orders and perhaps additional COVID relief passed. I don't know that it's always a guess. I mean, maybe the president's going to think, hey, while I can get something through reconciliation, while I've got the Senate, I'm going to push hard to unwind what was passed with TACJA. We're going to get rid of Trump's Tax Act, and maybe that will be a focus. If we do get reform passed between in the summer or fall of 2021, will it be retroactive to January 1st of 2021, or can we bank on having what we have in the bank for 2021? Can we count on our corporate tax rates, our capital gains rates, our individual rates through the end of 2021? It's, that's kind of a guess. So I think you can, but retroactive tax relief has happened in the past, Brad. It was in '93 when Clinton was elected. There was some tax reform passed in the summer that was retroactive to January 1st of '93, and the Supreme Court said it's okay. So it's not outside of the realm of possibility. But given the economic environment that we're in, given the political environment that we're in, and taking into account some of the commentary that Jonathan made at the outset, I don't anticipate that we'll see sweeping tax reform passed in 2021. It may become more of a focus in 2022 as we get to interim elections, if there's some sort of urgency, if the economy bounces back, and it seems to be there's some sort of urgency on the part of the Democrats to try to push something through if the Senate's at risk.
Maybe coming back to, go ahead.
Just concur with that. I mean, there are two political issues that Democrats are going to want to campaign on in 2022 that have broad popular support and play in their favor. One is soaking the rich, and the other is the minimum wage increase. And I think that keeping both of those as alive as political issues is probably something that they're going to want to do. And I would bet that neither of them happens, but instead they become more of political talking points. Neither of them happens in the short term, but conceivably, if they win greater control of the Senate or something down the road, then we could see both happen.
Well, that's good. Maybe coming back, Chris, two follow-up questions on the tax front. One, any update on taxation around carried interest? So maybe I'll do that, and then I've got a state question for you with any insights you might have.
Sure, Brad. It's been kind of quiet on carried. Carried interest is essentially the way the private equity investors take their cut. It's essentially something called a partnership profits interest, and when the portfolio company is sold and all of the investors get their original capital returned, then the private equity investor participates in his 20% cut on the deal. And typically it could be all or significantly all capital gain treatment. And the argument has been that that's too fat, and that maybe the cut that a private equity takes through its interest carry ought to be taxed at ordinary rates rather than capital gains rates. TACJA addressed it to some degree and put a 3-year holding period rather than a 1-year holding period for capital gain treatment on the interest carry. But that wasn't all that punitive, because the life cycle of most portfolio companies is going to be longer than 3 years. So that was sort of a win, I think, in TACJA. But what's happening now, Brad, is that with this idea that if you have over $1 million of taxable income, your capital gains are going to be subjected to ordinary income tax rates anyway. It's like you could win the battle with interest carry, but lose the war with the application of ordinary income tax rates to capital gains. And the $1 million is a big number, but again, as I mentioned before, the sale of a portfolio company is a windfall event. And in one particular year, you have a spike in your capital gains because of the sale of a portfolio company, which subjects it to those ordinary rates, which makes the tax on interest carry sort of moot if that's the way we go.
Right. Then pivoting on state and see if you have any insight here. A lot of discussion back in December at the federal level around PPP and the loan forgiveness, and the forgiveness was going to be non-taxable, but what happened to the expenses? That got cleared up by Congress before Christmas, but the states didn't clear it up. And so every state's a little different. Kentucky's clearly different right now on that front. Any updated thoughts around where Kentucky lands on this topic?
I know there's been a bill introduced, Brad, that would yeah. So what we're talking about here is if you took one of these Paycheck Protection Program, these PPP loans in 2020, the idea behind the PPP loan was, okay, here's $2 million, make payroll with it, and if you make payroll with it, then it's going to be forgiven. And the original CARES statute language said, and the forgiveness of the $2 million loan isn't taxable. It could be as high as $10 million. I'm just throwing out $2 million as an example. Then what wasn't anticipated in the hurry to get the CARES Act passed was another obscure code section 265 buried in the code that says, well, if you have tax exempt income, underlying expenses aren't deductible, which is fair. That wasn't Congress's intent, but what the IRS came out and said last summer was, well, we're going to apply 265 to the underlying PPP loan costs. So even though the forgiveness of the PPP loan wasn't taxable, we're not going to let you deduct any of those payroll costs that we paid for with the PPP loan, which essentially is the same way as making the PPP forgiveness taxable. You don't get to deduct the underlying expenses. You're paying tax on the money that you received in your PPP loan. Congress said that wasn't our intent, and then in the Tax Relief Act passed in December of 2020, they came out and specifically said that the PPP loan, underlying PPP loan costs for federal purposes are deductible, which was a very good result. Some of the states have decoupled from that, including Kentucky. Kentucky said, well, if we're applying a technical interpretation, we're not going to adopt what was passed by the federal government in December. We're going to apply 265 and say that the underlying PPP loan costs for Kentucky purposes aren't deductible. So essentially, Kentucky's the revenue cabinet has come out and said a technical interpretation means Kentucky's going to tax your PPP loan forgiveness by virtue of not allowing the underlying deductions. It would be an add back to your federal number. So if your federal income was X, you'd have to add back your PPP forgiveness to get to your Kentucky taxable income. There's been a bill introduced. I know the Kentucky Society for CPAs is advocating putting significant effort towards advocating a coupling of the deductibility of those PPP loan costs with what the federal government's done. We'll see where that goes. A bill has been introduced. I'd be guessing if I thought it would pass, but it feels like that's it's a way to provide some additional relief during a pandemic. And with the Kentucky Society behind it, if there's enough of a groundswell, maybe we'll get that fixed in Kentucky. Some other states have come out and said they're not fixed. California, for example, is a big one where California's just come out and said they're not going to allow the deductibility of forgiving PPP loans. It's kind of a tough deal, right, Brad? I mean, if you took a PPP loan, that means your business is struggling, pandemic's not over, and then we're gonna take back a piece of that grant that was provided to you to keep your business going through state tax. I'm kind of holding out hope that Kentucky does the right thing here.
Thanks. David, you mentioned in your opening, stay on the tax front for a second. You mentioned seeing some activity in 2020 being driven by the risk of an administration change and what that might be. We've had that now. And so some of the things that Chris talked about and Jonathan talked about this potential for tax change, what do you see that continuing to drive in 2021 and 2022 as far as deal flow, volume, or types of deals that might be coming about?
So we certainly think that as Chris and Jonathan mentioned, the threat of having your capital gains tax, this ordinary tax rate is going to influence a lot of particularly the family business owner, those people are going to probably make decisions to move. Now, if your business is not in a place where they can do that, then, you know, they may still hold out and just have to deal with it. But if you've been on the edge over the last, call it 2 or 3 years, you know, is this the time? Is this not the time? We think a lot of people are going to say this is the year to make a move. And so, as I mentioned earlier, we think that's going to drive a lot of deal flow, particularly as we get deeper into the year. We're seeing that now. That fits with all of the narrative we're hearing from investment banks around pitch activity being really, really high. From a private equity perspective, it still is going to be a hit. I think there is a little bit of a different focus for us just based on what we're trying to accomplish for that business over the long term. And so I think you're going to see people who, again, if it's a this year or next year, we might go this year, but I would say from our perspective, we certainly have a couple of things where we probably could exit and the next, you know, during 2021, and we're holding off because we think the business is not ready. And so I think your private equity owners are going to take a little bit slower approach to getting out this year, whereas I think a lot of your founders are going to say this is a good time to leave. So I think you're going to see more of that this year.
Great. Well, I don't see any questions in the chat, and I want to save some time for us as a community to kind of do our breakout session. So I'm going to circle back through the panelists for any final comments that they would have. And so, Jonathan, I'll kick back to you to maybe start with some closing remarks from your seat.
You know, I'm a recovering politician. If I were a real politician, I would repeat what I said before and then ask you all for money. So I'll keep it that. But I will just mention that this is going to be a challenging time in DC. And while I don't see revolutionary change, there's going to be a lot of change at the margins, and particularly with this issue of earmarks, a lot of focus on what Congress does for all of the various industries. And again, as soon as I get my shots, I'm headed to DC, and we'll have an office there and on Capitol Hill, and would be happy to facilitate any of your all's needs up in DC. So thanks so much for letting me participate.
Thanks, Jonathan. Chris?
I'd just like to underscore something David said that I thought was insightful. You know, I think we're in an environment now where there is some exhaustion on the part of owner operators if they were contemplating selling before, and then we're just crushed by the pandemic and are coming out of it. You know, even if they're thinking I could have got a 9x multiple 18 months ago and it's 6 now, but I just don't have the desire to rebuild and go through this again. I'll take some chips off the table. You combine that with an environment where there's a threat of an increase in taxes, that's a confluence of events that could lead to a very active M&A market and a lot of PE activity. So I thought that was insightful, David. I think I agree with that completely.
And David, I'll let you wrap us up.
Yeah, just on that point, I think it's interesting, Chris. There is a perception that over the course of 2020, moving into 2021, there's a big hit on multiples when it comes to deals. And while there was a small hit, it really wasn't as much as you would expect. It was a slight hit. And the way that we've talked about this is some of the businesses that we saw, well, I would say all the businesses fell into one of two categories, at least in our industry. It was sort of the things that it was just, let's say it was the end of fund's life and they needed to get rid of this as their last asset in that portfolio and they needed to get rid of it. And so they figured, hey, we'll throw it out and just see if anybody bites because there's so much capital waiting to be deployed. And so some of those businesses were not very attractive and those did bring down the overall multiple. The other thing that we saw though was a really good business, a business that did well through COVID. And particularly in our industry, that was sort of like the last attractive person at the bar at night and just got mobbed. And so those multiples went up significantly. I mean, for us, we feel like if we're bidding 10, 11 times on a deal, that's a strong bid. And we were losing by 2 or 3 turns sometimes on a bid where we felt like we came in really strong. And it's just people have to deploy capital. And so a good business, a good asset is really showing well. So the one thing I would say, and just this is if you're in a position where you're thinking about selling, you have clients that are thinking about selling, I think one of the things that they should not be concerned about is if I sell now, I'm going to take a big hit from a multiple standpoint. Those have remained fairly robust. And so I think it's a good time to make that decision. The one thing I'll say, just to plug Harbor Group, is if there's a way for us to help you as you're thinking about that, we'd love to be involved in that conversation. That's a big part of the reason why I've been spending time in Louisville and to begin with, is just to get to know people, see where we can be a resource and to potentially help people as they're trying to make these decisions.
Well, thanks, guys. And on behalf of the chapter, I would want to thank Jonathan, Chris, and David for your time and your insights you've shared with the group.